So we finished everything about the first topic in the last class. And so we are into the second topic from today. And of course, I've been telling you over and over, this is not the main lecture. The main lecture is we go by the pre-recorded videos, right, as the main lecture. So we've been into the main lecture since last week, right? So if you go back to let's say, course material, and you will see, already we have, those earlier topics have already been covered, right? And today we are, on factoring 1 and 2. So this is almost the towards the end of the second topic, right? So that means, these two videos were what were assigned this Tuesday, right? So as of today, you must be caught up all the way to this lecture, right? Factoring part 2. So the collaborate session is, review and reflection. So we are kind of behind. We're always, it is bound to be behind the actual schedule of the lecture, and you gotta keep up with these videos. Otherwise, you can't. We can't finish everything by the end of the semester. We'll be, if you just rely on the collaborate, you'll be missing a large chunk by the end of the semester, right? So always keep up with these, lecture videos, okay? And also, I posted recently, yesterday, I posted something about the supercode, right? So please read this. I also mentioned this on Tuesday. You must have the book and the access code, right? But if you are still waiting for your order to arrive, in the meantime, use this code, right? Originally, you were given 2-week trial, courtesy trial access. Everybody was, given that. I mean, you don't need the code for that. You just need to follow the instruction given. But, it's only for 2 weeks, counting from the day when, the first person activated that. So if the first person activated the courtesy access that on August 31st, then in the middle of September, then the first trial access will have already expired, and people who are behind it, the second person or third person, won't have those 2-week trial access. So that's why I requested another extension of 2 weeks, which can be activated by this super code. So don't fall behind other people, because anyone who activates it today, I mean, if the first person activated today, then the clock starts from today, right? And your chapter 2 practice problems, chapter 2 chapter problems are due October 8th. So if you activate it today, if the first person activates it today, today's the last day of September. So you'll still have time, plenty of time. I mean, as far as this temporary code is concerned, it's gonna expire then, like on October 13th, if the first person activates today. So, but the thing is the first chapter problem, chapter 2 problem, which is about the financial statements, it will be closing. It's due on the 8th, so October 8th. So you gotta get uh, you gotta get started, right? Right today, one way or the other. You don't have much time. Um, So that's it. And again, this only gives you 2 week window, right? This is only um, temporary access. It's only courtesy by the publisher, and after that you need to have your own code, right? Also the what else? Uh, and if you are still waiting for your book, and the book is the book has been published, I believe. The book has been, already, printed in the last. So it was back ordered, and then they got finally printed. I think the last week, early last week, because I believe I got some email about that. So it should arrive if you are, if you have ordered the book and still, waiting. Okay. All righty. So let me. So I have 12 people, and so let me. So I have. Okay. So the book and the. So we are moving on to the financial statements, and the financial statements refer to four statements. They simply, generally refer to it as book, right? Um, those four statements are income statement, balance sheet, cash flow analysis, and retained earnings statement. And this file, you must have, downloaded this file, and this file starts with balance sheet, but we will come back to the balance sheet later because income statement, it's always, most books somehow, for no good reason, most textbooks start with the balance sheet, but it's more sensible to start with income statement, right? Because and in this slide, we only talk about income statement and balance sheet, and also in this class, we'll talk about only the income statement and balance sheet. Cash flow analysis or cash flow statement and retained earnings statement will be discussed in Finance 230. Okay, it's going to be in Finance 230. And the reason, of course, the main reason is the income statement and the balance sheet are the primary statements, and the cash flow analysis and retained earnings statements are more like secondary statements. I mean, secondary not in the in importance, but what I'm saying is based on the primary statements, you can construct the secondary statements. Okay, because cash flow analysis is actually, it's just an example. I didn't go into detail in the slide because cash flow statement will be addressed more in depth in Finance 230. Again, so cash flow statement is based on you need income statement and balance sheet, the data from income statement and balance sheet to construct the cash flow analysis. Right? So cash flow analysis is the analysis. Literally, it's an analysis of the income statement and balance sheet. So that's why, I call it the secondary statement, right? It's because it's the analysis of the primary statement. So we're going to mainly talk about the income statement and balance sheet. Yeah?
It's Julian. Are you sharing
Yeah,
your
Judy.
screen?
I'm sorry. Because I'm sorry. Yeah, thank you for mentioning.
Someone else mentioned it in the chat. I thought you were.
Oh, I couldn't, when I'm looking at the files, I cannot see. Uh, well, thank you for reminding me. I was in a rush, as I told you, I took I took shingles shot this morning, and then, had to drive a family to the doctor and drop off and pick up, and in the meantime, and then when I came back, when I came home, and there was a like interruption in internet connectivity, so when such a rush, and I apologize. Yeah, I was actually I was showing you this, and then these files, as always, gotta get back to, as always, right? You find those files in the topics folder, right? And I was, showing this, but I was completely oblivious that my screen wasn't being shared. So yeah, this is the PDF file, and this is the Excel file. You must have them in front of you. You must have them opened in front of you, especially this Excel file. And then I was talking about, these lectures have already um, been made available, and they were uh, assigned for the last week's classes, but some of them are already more than 5 days old, so they are not here. It's not visible. I mean, it's just not visible. And this is your class. So today, what is visible today is financial statements 1 and 2, right? Let's see if it is. And then factoring part 1 and 2. These are the ones that are assigned today, and these are the ones assigned Tuesday. Okay, so as I said, you must be all caught up to this point. This is the main lecture, not the collaborate, and whatever is older than 5 days, right? I told you, I gave you my YouTube channel. You can, you can find it there. Okay, so I was talking about, so I was starting on the income statement. Now, one thing we have to make clear is that the income statement and balance sheet have two different purposes, right? And most people, when I ask them about the either income statement or balance sheet, they get the line items all mixed up, even if they have already taken accounting class, and but even after accounting class, they still get it all mixed up. Why? There are two reasons. The primary reason is the accounting class doesn't um, deal with the reasonings behind it. Reasoning why we are doing this, why this is done this way, why this comes after this, why this comes, why doesn't it come prior to this, but why this line item has to come after this, and why is it named, why it's named this way. They don't try to explain anything like that. They just focus on the procedure, right? And then you're just supposed to memorize that. But in this class, we are more focused on the logical reasoning behind it. Why it is called why is the name, why the name of this line item is this way, and why it's, why it comes after this, um, and what purpose it serves, that's what we are focusing on. And as part of that, we also emphasize on why the line items are different between the income statement and balance sheet. Actually, there are only two line items that are common to income statement and balance sheet. Otherwise, they are all different. But then, even after taking accounting class and even after taking this course, a lot of students are still confused, and they can tell the difference between the different line items the line items that must belong to the balance sheet and the line items that belong to income statement. They can't distinguish. So that's why that brought us to this point. These two statements serve different purposes, right? They serve. I have balance sheet here, but I'm not showing you. We're starting from income statement. So if you have this Excel file open, keep in mind it's starting from column I, right? Income statement starts in column I, not in column A. Yeah. So now let's think about it. What is the purpose of income statement? What purpose does it serve? What is the purpose of income statement? Okay, I can't expect you to answer this question just yet, but the income statement, the full name, income statement is actually a short for income and expenses statement. So the full name is income and expenses statement. Okay, so that means it will list income, right? Whatever sources it is coming from, right? Whatever sources the income is coming from, you will list all income, and then you'll list all the expenses. And whatever is the reason for expenses or the sources of the expenses, you will list all of them. And of course, then it's a common sense that when we have income and expenses listed, the natural course of action is subtracting expenses from income. Isn't that right? Even if you have no education in finance or no training in finance or accounting, anybody, it's all etched in our DNA that when you see income and cost or expenses, then of course you'll have to subtract the cost or the expenses from income, right? And then after that you arrive at what do you arrive at when you subtract? If you subtract expenses from income, what do you arrive at? Anybody? What do you arrive at if you subtract?
I guess your disposable income.
Disposable income. Yeah, in a way, that's not incorrect. Yeah, but that disposable income is in case of personal income. Yeah, someone was trying to say something. Someone was trying to say something.
Revenue.
Oh, no. Revenue is part of income. Revenue is basically primary income, primary source of income, right? So actually, disposable income is after subtracting taxes from your income. That's called disposable income. But that is in case of personal finance. Personal case. But in business, right? In personal case, so disposable income is even before subtracting expenses. you'll have to subtract taxes first, and then from your personal income, personal gross income, and then from that you subtract that's disposable income, and from the disposable income you can subtract your expenses. So let me start with two different cases, personal and business, right? And we are looking at the business case because think about it. Businesses keep these, statements. Businesses construct these statements. People don't. Individuals don't have income statement or balance sheet. Of course, you can keep track of your spending. That's your income statement. I mean, you can keep track of your income and your spending. That's your personal income statement. But that's not income statement in the business sense. So, but think about it. If you subtract all expenses from income, roughly that's called profit. Roughly that's called profit. Isn't that right? If you subtract expenses from income, that's roughly, or revenue, subtract cost from revenue, that's profit. But that's not the correct, that's not exact term just yet. So let's take a look. First,
Is it the net profit? Because the gross profit.
No. Net profit is after paying taxes.
Oh.
Okay. Net profit is after, that's what comes after paying taxes. But prior to that, nothing is net profit, right?
Yeah.
First, let's take a look at income. First of all, income comes from two sources, largely two sources, right? Income comes from largely two sources. One, revenue, right? It's basically sales revenue, right? Sales revenue, short for we don't because sales revenue is two words. We can just call it revenue. Think about it. Every company has to sell something. Every company has to sell something. Isn't that right? And that's the primary source of their income, right? So the revenue is the primary source of income. And the secondary source of income is investment income. Now, investment income is like, it's passive income. Investment income is passive income. Why? Think about it. You're not doing anything, investment income comes from the savings of the company, because company can eventually at the end of the operating activity of the company, right? Eventually you will end up with the profit, right? And the profit or loss, there's no guarantee you will have profit, but loss is negative profit. But let's say in this example, the profit is negative. But if the profit is positive, there are two things that this company will do. Two things this company will do with this profit. They can reinvest. They will reinvest it into the company. Reinvest means reinvesting means that the using this, plowing back this profit into the expansion of the company. The company will need to increase their production capacity, right? Because if the business is booming, right? And first of all, if the economy is booming, the business will be booming. If the economy is growing on average by 5%, right? If the economy is growing but at 5% growth rate, then that means on average, all the businesses on average, all the industries are growing at 5% on average. Isn't that right? Does it make sense? of course, actual growth may be different. It will vary from business to business, industry by industry, but on average, businesses businesses will be growing at 5%. And first of all, if the economy grows by 5%, that means income. If 2000, if the economy grew in 2020, right, by 5%, that means at the end of 2020, everybody's income was, greater by 5% on average, right, compared to the end of 2019, right? So then if everyone is 5% on average, 5% more, wealthier, or, has 5% more income, then you can also expect on average, everybody's spending will grow by about 5% on average, right? Once again, it's average concept, right? Because some people will just save all of it, or some people will spend all of it. But on average, and everybody's income growth will vary from one person to another. But on average, we can assume that spending goes up by 5% on average, right? And then that means if the spending goes up by 5%, what does that mean? Demand will go up by 5%. If the demand goes up by 5% on average, right? And that means, for every manufacturer, right? For every business, retail or manufacturing, the demand for their products will go up by 5% on average, right? Makes sense? If the demand goes up by 5%, then the company will need to expand their production by 5%. They will have to increase their production level by 5%, right? And if the company has excess capacity, right? If the company currently has excess production capacity of 5%, they can handle extra 5%. But if the company doesn't have excess capacity, what will they have to do? They will have to expand their production capacity, right? Does that make sense? And if they expand their production capacity, then that means they will have to hire a construction company to build excess capacity, right? To build another plant. I mean, when they build another plant, it's not going to be just for that extra 5%. They will build another plant with the long-term projection of long-term demand increase. So if the economy grows on average by 5% every year, right, for the next 5 years, the correct way of calculating this is 1.05 raised to 5, right? 1.05 raised to 5, right? Minus 1. That will give you the net compounded growth over the next 5 years. But just to simply think about it, right? If it by just simple calculation, it's going to be 25% by simple calculation, isn't that right? 5% times 5. So if the economic outlook is positive and based on the demand forecast, if the demand based on the forecast of the GDP, if the GDP is expected to grow on average by 5%, you can also expect the demand will grow on average by 5%, right? So far, everyone is following? Everyone is following so far?
Yes.
Okay, good. I can count on you, Jodian, because at least Jodian, there's one person following me. What about other people? Are you following? Angelica, are you following
Yes.
so far?
Yeah.
Okay, good. Fahad, are you following so far? Fahad, are
I
you
guess,
there?
yeah. You saying
Okay,
that
good.
basically everything
Okay.
increases by 5%, right? Like,
Yeah, yeah, on average, 5. Jeremiah, are you following so far, Jeremiah?
Yes.
Okay, good. Carolis, are you following so far?
Yes, I am.
Hmm? Okay, great. Well, basically, that's how you're making a forecast, right? Yeah, first, it's primarily based on the demand GDP, right? And if you have GDP forecast outlook for GDP forecast, then based on that, uh, your demand forecast can be based on the GDP growth rate. Maricel, are you following so far? Maricel, are you there? I guess Maricel is not there, or uh, bad connection or whatever. Naomi, are you there? Naomi?
Yes, I'm here.
Okay, are you following so far?
Yes, I am.
Good, good, good. Nicole, are you there? Nicole?
Yeah, I'm here. I'm following.
Okay, are you good, 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 great. Nickery, are you following so far? Nickery, are you there? Nickery?
Yes, I'm here.
Okay, and you're following so far?
Yes, sir.
Okay, great. And Noel, are you there? Noel, are you following? I see your microphone, but I don't hear anything. Vivian, are you there? Vivian, I see your microphone, but I hear nothing. What's happening? Are you following, Vivian? Okay, Noel's following. Okay, all right. So basically, so think about it. If the economy is expected to grow, for the next 5 years, on average at 5% rate, you need at least like 25% more production capacity. But as I said, if you have excess capacity to handle that, that's fine. But then there is no way, uh, there's no way you have like 25% excess capacity. Why? Because if you have 25% excess capacity, that means your plant has been underperforming all these years. 25, I mean, 5%, 10% excess capacity is acceptable. But if you have like 25% excess capacity, your plant has been underperforming, underproducing its, full capacity. And if the plant has been underperforming, that means you had to pay for that plant. I mean, all these years, uh, you had to pay for this plant, but you couldn't because you were underproducing. If you are underproducing, you are underselling. If you are underselling, the revenue generated from your sales was not covering the cost of construction of that plant. You couldn't even have recovered it. So obviously, if you have had like 25% excess capacity, then that was a very, unprofitable business. That kind of business must have been unprofitable all these years. So if, in other words, as I said, about 5 to 10% excess capacity is understandable. That's possible, but 25% excess capacity is not plausible. It's unthinkable. So over the next 5 years you will need 25% more capacity. So what do you have to do? You will have to uh, build a new plant, right, that has that can meet this 25% additional capacity, right, additional demand. So you will need to build a plant that has equal capacity as the current plant, or at least something if you're building another plant, right, another plant, it will most likely will have to match the current plant capacity, because you are basically you are planning for the long term. And once you build a plant, it cannot be like disassembled one day and moved around. It's a real estate, right? In other words, it's a concrete building, and you have production equipment in it. It cannot be disassembled and moved around. Easily sold and moved around, right? So you have to plan long term, and so the new plant basically. Reinvesting means reinvesting in the capacity expansion, right? Reinvesting in the capacity expansion. So that's one thing you can do. That's one thing the company can do, right? With this, net profit, right? And of course, net profit, one period alone, net profit from one period alone is not enough, right? It cannot. All of these net profits year after year retained within the company will be used. So that's called retained earnings. All of these profits retained within the company accumulated over the years, and it's gonna amass to something. It's gonna amount to something, and that can be used for capacity expansion. And so they reinvest the profit, or the second thing they can do is they can invest in the stock market, right? They can invest in the stock market, meaning either you can use the profit, you can reinvest the profit into yourself, in the company itself, or the company's expansion or growth of the company, or you can invest it in other companies, right? You can invest in other companies. Now you might wonder, why would you invest in other companies? Look, other companies are not necessarily your competitors. It sounds like investing in other companies sounds like investing in your competitors. No, you can also invest in your competitors as well. That's nothing new. Why? Apple has a lot of shares of Microsoft. Microsoft has a lot of shares in Apple. Microsoft and Apple are not direct competitors because Microsoft is a software company. Apple is both software and hardware. And Samsung, Apple also has a lot of shares in Samsung. Samsung has also a lot of shares in Apple. And that's not, why not? Look, Apple doesn't have to own. Apple has some of its own shares. It's called, treasury stock. But shares are something you sell. A company sells to raise capital from the public, right? So other companies can buy your stocks. There's no problem, because anybody who pays in capital for your stocks, that's good for the company. The only thing is that if Apple has shares of Samsung, Samsung has shares of Apple, they cross-own each other. The only thing is there's nothing wrong with that, because as long as there's paid-in capital coming in, and it's not happening constantly. It's only when but the idea is, as long as Samsung doesn't own too much of Apple, or as long as Apple doesn't own too much of Samsung, right? As long as they are competitors, as long as the competitors are not major shareholder of your company, that's fine. Okay, but the stocks are held in the market by the public in the market, right? So how can you prevent Samsung from owning more than 15% of your 15% is already a major shareholder. But think about it. if Samsung owns 51% of Apple, Apple is really owned by Samsung, isn't it right? Because supermajority, 51%, nothing can beat the supermajority. As long as you have 51%, you can wield the direction, right? You can wield the axe on the direction of the company, right? Nobody can. 51% is the supermajority, and all the decisions are basically made by the 51%, right? So Apple doesn't want Samsung to own 51%. Of course, it's hard to own 51% of any company. I mean, majority shareholders at best owns like 11%, 12%. That's the maximum, right? You cannot. The ownership must be diffused, and even the major shareholder cannot generally don't own more than 11, 12%. Very large corporations, right? With huge shares outstanding. But if Samsung wants to buy from Samsung can, because shares are traded in the market, Samsung can buy from other shareholders, right? I mean, as long as you offer, there's no way you can prevent it. Of course, the only thing you can do is to if somebody is buying massively, in massive quantity, if somebody's buying Apple share, then it will be automatically on the radar screen of Apple, and Apple will the major shareholders of Apple, right? The company Apple doesn't, the company is an inanimate entity. Company is an inanimate entity, and whoever owns it, the company doesn't care, because company is not a person. Company is just a vessel. You have to understand that as company is only a vessel, isn't it right? Vessel for channeling the profit to the shareholders. So it will be the major shareholders of Apple who are on the board of directors, and it will be on the radar screen of Apple's majority board of directors, and then they will basically they will buy also, as a countermeasure, they will buy a lot of from the market to prevent one particular shareholder becoming too big. And if they know it is one of their major competitors, then they will be on an all-out war to prevent that from happening. Now, we kind of digressed a little into some kind of corporate ownership control battle, but so let me get to the rest of it in the next class, because we're already out of time. But let me tell you, the goal of the income statement is the profit, right? A goal of the income statement is to describe the process leading to profit, and the goal of the balance sheet is to describe the capital structure. So they have two different goals, and please establish this in your register this in your brain today, and register it clearly. They have two different goals, and that's why they have different line items. So if ever somebody's asking about balance sheet, please don't get it wrong. The balance sheet is not about profit, right? You cannot. It doesn't tell anything about the profit directly. You can take a peek indirectly, but not. You can tell nothing about profit from the balance sheet, right? And you have to look at the income statement to get an understanding of profit. Okay, so that's it for today. I will so I will have to stop sharing the video. So I will see you guys on next Tuesday. Have a safe day and have a great afternoon.
Professor, Miss Judy,
Yeah,
I have a
yeah,
question.
yeah.
I've been watching the videos for part 2, topic 2, but I haven't.
Uh-huh.
I ordered the book since the 31st of August. It still haven't arrived. So where exactly do I go to get the book? The 2 complimentary pass?
No, I already look. So if you go to, I gave you the super code here, and if you go to course information,
Yeah.
right? It was already explained at the beginning of the semester. If you go to the course information, anything about information, it says course information. So go there, and there's a connect site link, right?
Okay.
So if you click on that, it will take you there and follow the instruction exactly to the letter. Okay, you use, BMCC student email, please. And, when you create profile there, you put your last name first, right? Put your
Yes.
last name first and comma and the first name so that, it will all line up exactly like the order of the roster, order of your names in the roster. It will match the order of the roster, order of the name in the roster. Okay, and
Okay.
then you'll have to don't click on this because first you have to sign up and then you can sign in, right? Without signing up means you are creating an account, but without an account you can't sign in, right? So the first thing is okay, alrighty.
Yes.
Alrighty, then I will see you guys next Tuesday.
Okay, see you. Bye-bye.
Bye, Professor. Have a good weekend.
Alright, you too.